Are you looking to become a leader in clean energy and an expert in clean tech? Do you hope to get noticed in the crowd as you pursue a career in this fastly growing industry? You are in the right place. Join Karan Takhar as he invites clean energy leaders to share industry developments, highlight clean tech investment opportunities, and shed light on how you can increase your chances of employment in this high-growth sector. We will also discuss the energy transition across key emerging markets like India and explore partnership opportunities for the U.S. private and public sector. After all, this is the Zenergy podcast.
Hello, Eric. Thank you so much for taking the time to join the podcast. I'm really excited to speak with you and to learn about your career journey, which is really exciting, and also learn about your work at Activate.
Absolutely.
Really appreciate it.
Yeah, thanks for having me on the podcast. It was great meeting you a couple of weeks ago. Great having you to our offices, and great to meet the fellow Wharton students.
Beautiful offices.
Yeah, thank you.
No, really appreciate you taking the time. I know a lot of people express interest in learning more about the work of Activate and also what the process is to be able to work at such an impactful investment company. So excited to dive into these questions. And before getting into the actual workflows of Activate, could you just tell us a little bit about your career journey, how you got to your current role as a principal at Activate Capital, and what compelled you to work in climate investing?
Yeah, absolutely. Happy to kick it off there. And I think my journey will kind of tell a little bit about, help tell a little bit about the story of Activate. And so I think it can best be, started by looking at kind of going back to high school. I was always really intrigued by the hard sciences. Chemistry was my favorite subject. I worked in high school for a professor, Dr. Hammers at the University of Wisconsin in nanochemistry. And so when I went to undergrad, kind of continued down that journey. I actually was a chemistry major. I was a TA in organic chemistry. So I just loved it. I ended up doing my research as an undergrad with Dr. Hazari on organometallic chemistry, which actually looked at using kind of novel catalysis to drive the conversion of carbon dioxide into kind of chemical feedstocks. And so this process was, I think, the first foray for me into like what we called green chemistry back then. Ultimately, through that, I learned that I wanted to be more on the kind of application side of science, of technology and sciences, and so used that experience and actually interviewed with the big consulting firms and wanted to come out to San Francisco. And so I ended up joining McKinsey out of undergrad out in San Francisco. I did that for 3 years. Absolutely kind of loved that. I liked working closely with companies and really kind of helping them think through different problems. And it's pretty crazy looking back on it that a 21, 22-year-old is even like, can even kind of add much value in that context. But I learned a ton. Decided after that I wanted to kind of jump into the investing side, and so joined a public equity fund called ValueAct Capital, also here in San Francisco. And really the strategy can be best defined as kind of private equity in the public market. So really using kind of shareholder activism to create value. And the strategy was really to look for kind of mispriced assets that were going through some sort of disruption, some sort of change, but it had real strong secular growth drivers to them. And we could also drive value by joining the board and having a very activist approach. And so right when I joined, we were early investors in Microsoft. Mason Morfitt, who's now the PM there, took a board seat. We're also early investors in Adobe, and this was right around kind of the early innings of the SaaS revolution. So the license to SaaS conversion, you take an earnings hit, and we were able to kind of see through that. And then also we're kind of a part of the transition of bringing Satya on as the CEO at Microsoft. So that was just like amazing to see up front, like how powerful kind of shareholder activism could be. Through that journey, I decided to go back to business school, and in part because in the hard sciences, it was like the way I often tell people is like jumping into the deep end when I joined a hedge fund, and it was wanted to go back and kind of learn some of the fundamentals that I thought would be key. And then the other goal was really I was a generalist at both McKinsey and ValueAct, and I really wanted to kind of start to kind of go back and focus on gaining more expertise in kind of the energy transition, or what people used to call clean tech. And so decided to go to business school, and you really use those 2 years to join the energy club, private equity club, these different clubs, and really try to build up my network. And at this time, there was kind of the second wave of clean tech funds that were popping up. Folks like G2VP, Energize, Activate Capital, many others. And so, I just used my network, used my Wharton network, used my personal network, and just started having conversations with these different funds, and really gravitated towards Activate. I think, the first 2 investments that Activate had made, even before it was a fund, out of kind of a warehouse facility, were in 2 what I thought were the marquee assets in the space. Generate Capital, which does financing for distributed energy infrastructure, and then STEM, which is kind of battery storage intelligence. And so I was like, who are these guys? Like, these are 2 of the cooler businesses that I see in the space, and I can barely find anything, on the website about them. And so had coffee, like every good MBA should do. You just have a coffee chat, and I really kind of resonated with what they were looking to build and the platform that they were looking to build at Activate. And so I got a call at the end of my first year. I already had an internship lined up, but I got a call in like May, right before you're supposed to go off your internship, being like, hey, like, you're still available, like, we'd love to have you. And I was like, well, I already have an internship locked down, but I'd love to spend 4 to 5 weeks with you guys at the end of the summer. And so luckily they said yes. And so I only spent 4 or 5 weeks. This was back in 2018. The fund had just launched as a 2018 fund. And I got to work on a really interesting transaction on the cybersecurity business and for critical infrastructure. And I immediately kind of fell in love with what we were looking to do, and the people that were already there. It was a small team. It was like 5 of us. And so, lucky, proved myself enough to be able to get to continue the conversations. And then in 2019, my second year as a Wharton student, got kind of the offer to come back full time. And so we actually at that time had a Philly office. So I started commuting from Wharton, once or twice a week to the Philly office, just to kind of keep the relationship going, and then join full time when I graduated. So that's my journey.
Super interesting, and incredible how a coffee chat ultimately led to an internship offer in April, May. And then
it's several coffee chats. If you keep track of all the coffee chats, yes, I'm sharing the story of one where that led to a job, but there were many other unsuccessful coffee chats.
What do you think made that coffee chat successful, if you recall?
I think like part of it, and maybe you're kind of indirectly asking something about this, but like, what do we look for? Like what's helpful and kind of in recruiting for this? I think it's like, honestly, just being open and intellectually curious and kind of coming to the table with something. And so like, I had this like passion, I had a dream of what I wanted to do, and Activate was just being kind of formed at the same time. And so sometimes these vision values don't align, but like the mission statement and what we've kind of created here at Activate is really to accelerate the world's transition to a more sustainable, resilient future. And everyone that we hire, including myself, kind of buy into that and believe that. And so I think that's first and foremost. Like, I think Raj, who I was having this coffee chat with, one of the GPs here, he was previously at DFJ, previously at Silver Lake. So he was early in Solar City, early in Tesla, early in SpaceX, early in Enernox. A lot of these like pioneering companies of the first clean tech wave. And so I think sharing that, and I think we talk about our values here at Activate, and it's about kind of persistence, candor, humility, or empathy. And so I think you have to, in these kind of early coffee chats, you're not gonna be pulling out like an LBO math on the table. You're not gonna be like wowing, so it's a little bit of just being genuine in these conversations. And so I think like the thing that I often talk to people about is kind of the empathy side of our business. And I think I shared this when you all were out at our office, but I mean, the founder journey is really hard. And so you want people on the other side of the table, you want investors recognizing that, and just being able to kind of empathize with that founder journey, and have humility to know that like you might be wrong. And I think yesterday we were talking in the office, we are talking about valuations and certainly as like the Wharton guy, like, I like to like be a little bit, high horse about, the right way to approach valuation sometimes. But it's interesting. We were talking about this company that's got a term sheet and the multiple was high. And immediately one of our team members was saying like, oh, it's too expensive. We shouldn't look at it. And I kind of was like, well, I don't know if that's the right way to approach valuation work. I think the first place that you should start on these things is from a place of, I don't know. Like, I generally don't know the valuation. Like, I don't know, much about the business until you actually do the work and defend the assumptions that go behind it. Like, you should start from a place of ignorance. Like, I don't know. That doesn't mean you shouldn't use heuristics to help kind of like streamline some of the work you do, but it is a reminder of like, you need to have genuine like humility in this game.
Makes a lot of sense. And could you actually expand on how the investment process at Activate works? I remember you speaking some to this when we visited the offices regarding how ultimately the person who finds and sources the deal then presents it to an investment committee. And I thought it was really interesting at the time. So could you just provide some insight into how that process unfolds?
Yeah, and like any company, we've been kind of building out the infrastructure of our whole sourcing engine all the way from deal, kind of due diligence to deal execution to investment. And so I think along that pipeline journey, we see about kind of 2 deals a day. So it's a lot of like throughput, and some of those are inbound, some of those are direct inbound, some of those are kind of introductions from our network, some of those are outbound from us. And so first and foremost, we like to be very thematically driven. So we like to know what we're looking for before we even find it. So that's kind of point number one. But every Monday we kind of review our watch list and our sourcing, and we kind of bring up things. It's typically been maybe 30-minute conversation you've had with the founder. So it's like, again, a place of curiosity is where we approach it from. So like, here's the founder thesis, trying to really kind of think about it from the founder perspective rather than even editorializing it ourselves. But here's what the founder might be looking for. Here's why we think it's interesting, and having like initial perspectives. We go around and we just give we call it like a pulse check, and just try and give a kind of a quick thumbs up, thumbs down, everyone on the investment team, and use that as a gauge to, hey, should we actually staff up resources on this? Because time is our most precious resource. And so if there is a little bit of a pulse check, people seem to find it interesting, then the deal team will try and do a little bit more work, and we have kind of different stage gates, and we have typically kind of a deal team qualified than a firm qualified type approach. And so the deal team will do something, they'll convince themselves like, yeah, this is interesting. They'll come back to the table, they'll typically put together kind of a 10 to 20 page PowerPoint, and yes, we use PowerPoint here, but kind of put together the PowerPoint. What is the thesis? Why is it interesting? What are some of the risks you've identified? And that's where we'll kind of do the firm qualification. That says, yeah, there's actually could be something here. Let's kind of go into more formal due diligence. And through that formal due diligence process, we might build out a 50-page deck. We're doing the customer calls, really trying to build out what our investment thesis is, and really looking to get conviction around 3 things, especially team, TAM, and moat. And then also start to convince ourselves around kind of the why now, like why is the right time for this business? Like, why should we be back in this kind of sector? And does this company really have product market fit? And so that takes a lot of customer calls. And through that journey, we'll come back and the deal team will present it back to the investment committee. And at that point, we have more of a formal voting system. But to the extent that the investment committee is affirmative of the investment criteria, then we'll put down a formal term sheet at that point. So term sheet will be submitted, and in that term sheet, we'll typically ask for another 4 weeks, sometimes on the earlier side, but could be 8 weeks, could be even longer in some cases, to do kind of post-term sheet diligence. And that's when we'll bring in the legal. We might do even more customer calls, executive background checks. So just refining our models with even more data, and making sure that we're aligned with management, looking at kind of management executive compensation and performance targets, and kind of really, this is unlike public markets where I was before, in private markets, it's more akin to a marriage. Like, sure, you can get divorced, it's messy, but like you are signing up for a 5, 6, 10-year journey. And so you really want to be like aligned with this founder.
So when in the company's life cycle does Activate generally come in? And could you put this in the context of the climate investment landscape more generally?
Yeah, happy to. So we kind of skip past it at the beginning, but basically, like, Activate can be best described as a late stage venture / growth equity firm. And so, that what does that mean? That we kind of start getting to know companies at the Series A and Series B, and then really our sweet spot is investing at that Series C and Series D level. When companies, going back to the diligence process, where we can convince ourselves that companies have true product market fit, that they've de-risked the technology, and they're going after, kind of big markets. And so often the threshold we use, just because it's easy, is like, does the company have at least $10 million of revenue? The median revenue for our Fund 2 portfolio is much closer to 50 million now. And so we're like, I think one of the things that we're starting to see is like the maturation of the climate tech space. Fund 1, the median revenue was just a lot smaller for our portfolio. And so, going back to kind of the landscape, even when I first joined back in 2018 with Activate, there was a good kind of cohort of early stage specialists in this climate sector. And I won't name any of my names because there's so many that I could name, that I don't want to leave any off, but a lot of seed, Series A investors, and the relationships with them is super important to us, because that's where a lot of our deal flow and warm inbounds can come. There's another kind of wave of peer funds that often play a little bit earlier than us, but do kind of similar type investing, kind of engaging at the Series A and B. Companies might be $1 to $10 million of revenue. And so we really thought that there was kind of a sweet spot and really a gap of capital between that kind of $10 to $100 million of revenue. And what's interesting is when I first joined, so in Fund 1, we were kind of one of the last pockets of capital before companies could get acquired or even go public. I think what's changed significantly since then is there's a lot more later stage capital that's formed. And so, these are the big private equity players that have launched their, $8 billion climate funds, $5 billion climate funds. And so, like, that is a great stamp of of approval for like this space, this sector, and it helps us because it helps provide capital, after us. So if we're investing at the Series C and D level in companies that are doing $50 million, like who's going to be investing, after that? And typically, like on an equity value basis, and these companies might be anywhere from like kind of $100 to $500 million in terms of equity value. So if we're underwriting to I'll call it a 3x, and we're entering at the kind of the higher end of that range at a $500 million equity value, like, we're underwriting to a $1.5 billion exit. Like that's a big exit. And there aren't historically, if you look back a decade ago, there weren't a ton of $1 billion plus exit in the space. And so I think like what's changed is you have seen a rotation in the space. Structurally, LPs are deploying more capital. The follow-on capital after us is starting to become more robust. And you're starting to see kind of early winners in IPOs beyond just Tesla. Nextracker's been doing quite well. It's an example of one that went public recently. So,
and what do you think is driving all of this new capital into the later stage climate vertical?
Yeah, and I think ultimately, like, LPs control the purse strings of where they're allocating capital, and I think like people recognize there's real value in the kind of the sector has proven itself. And so I think like statistics that I often refer to is when I first joined back in 2018, there's about $500 billion going into energy transition capital. And we can talk about kind of what form of capital that takes. Today, or last year, 2023, that was 1.5 trillion. So kind of a 3x since I've been doing this. If you read reports from McKinsey, from UN, from others about what it takes to get to kind of net zero, which is again what we're all striving from a mission perspective, we're still way below the targets that we need to be at. We need to be kind of closer to 5 trillion of annual spend. So we're at 1.5. We need to be at 5 trillion. And if you look at kind of the the technologies that have come down the cost curve, solar, wind, batteries for EV and stationary storage and others, like these are all in the money technologies. And so if you look at, kind of the forecast for deployments of new energy generation, it's at least in the US here, it's almost all clean energy generation. You're not building new coal plants. You're really not building much natural gas anymore. And so like, these technologies are proven. There's a clear kind of like capital markets at the asset level. So you can get asset level financing for these things. And the yields, the kind of the cost of capital that investors demand has come down. And so like a simple example, Sunrun had their earnings call this week. I listened to it, and they talked about their most recent securitization of their portfolio of residential solar leases. And so a solar lease is typically kind of a 20, 25 year offtake with the consumer, where they're paying a certain fixed rate per month back to Sunrun. So Sunrun can take that contract, bundle it up with a bunch of other homes, securitize it, and flip it to Wall Street. And they said on the earnings call that the spread had dropped to 215 bips. And so kind of where cost of capital is today, that roughly translates to kind of a 7.5% kind of cost of capital. But 215 bips above kind of the benchmark is pretty low in terms of like the risk premium that investors are demanding for these infrastructure assets. I think that trend, if you go back a decade ago, like the premium was much, much, much higher. And so that allows more capital to kind of flow into this space.
Understood. Yeah, that's super interesting. And just to dive somewhat further into learning about what the key drivers are for the climate field and what's incentivizing these later stage investors and more capital to flow into the space. Are there, for example, any particular, like the IRA legislation, or and like what is your sense around how the current political climate is playing into climate more broadly? Because of course it's an important year politically within the US, and does that impact your own calculus and like Activate's calculus or investors' calculus more broadly? Just love to hear a little bit about how like politics and legislation plays into this trend.
Yeah, no, it's certainly $1 million question that we ask ourselves quite a bit about right now. Yeah, look, I don't have a crystal ball. I do think like what I can say about the political environment is if you look at kind of what public equity analysts are talking about, I do think there's recognition that there's an overhang on the market right now. Like people are a little concerned about various kind of tax credits that kind of flow through the IRA. There's certainly lucrative incentives, these kind of 45X manufacturing tax credits that flow through the infrastructure, bipartisan infrastructure law. So I do think there's a little bit of an overhang right now. I think one thing, just kind of looking back on the kind of implications of what we're seeing so far, I think we reviewed this at our offsite earlier this year, but if you look at the economic data, so you have what's if you kind of look at the past 2 years, then we had massive hike in interest rates. And the way that was once explained to me that I really like is like these clean solar and wind don't have fuel sources like like a natural gas plant where natural gas is the obvious commodity. The kind of fuel is the cost of capital. And so like there is, as cost of capital went from virtually kind of zero or 200 bips above zero to 200 bips above 5%, where we are now in the interest rate cycle, like that is a massive increase in cost in terms of the cost to deploy these clean energy projects. So that's like an obvious headwind. I think what was interesting when we looked at the data, you had this incredible fiscal policy countervailing trend with the CHIPS Act, with the IRA, and with the bipartisan infrastructure law. And so when we looked at, if you look at just like CapEx, and it's actually been more or less in real dollars flat if you go back far enough. And if you look at this past year, it actually 2x'd. And what's typically which should be a very cyclical type of indicator, like very much follow the economic activity, actually was countercyclical. And so that is really kind of evidence of the effect of like what the IRA, what the infrastructure law is already having. And so just in terms of like high level stats, there's been roughly $600 billion in planned investments in these various categories. And so I do think, kind of getting back to the political, is like, where are these $615 billion of planned investments coming towards? In a lot of red and blue states, actually disproportionately red states. And so I think what's popular on both sides of the aisle is like the reindustrialization of America, is bringing back manufacturing, is bringing back of these jobs. And so I do think when it comes down to it, regardless of who's in office, like if you're going to a state where a factory is being built and you're saying, hey, those dollars are no longer available, like I do think that's going to have its consequences. So it's hard to know exactly which parts might be more or less at risk, but what I can say is that it's the positive consequences that we've seen in terms of investment in America, in terms of investment in green jobs, has been great. And hopefully both parties will kind of see that as we move, if we change, have a new party leading for the next 4 years.
That makes a lot of sense. And are there any particular emerging technologies that you are most excited about in the climate tech landscape currently?
Yeah, so it's interesting. So because just to kind of level set it, because we do play this Series B and D, it is growth stage capital, and so I think when we get this question, there's certainly other funds out there that are kind of earlier stage seed investments that might be investing in kind of next gen novel technologies. This might be like fusion or some of these like sexier types of technologies. Like where we come in, actually, when I was at a conference last week, and there was a question posed to a panel of utilities, and the question was, what is the next 10 years going to look like? And basically the answer, if I summarize it, was like more of the same. Like it's going to be more of the same. It's going to be more solar. It's going to be more wind. It's going to be more storage and more electric vehicles. So we have the technologies that we need to kind of like to really deploy over the next 10 years. The 10 years after that, which is different pockets of capital that are really kind of working on the innovation around what that might look like. That could be kind of some of these more novel types of technologies. So with that as a caveat, where I think the interesting areas that I've kind of been spending time, we've been spending time on as a fund, is really around kind of home electrification, distributed generation. So really kind of democratizing access to clean energy, and then building on top of that, the intersection of kind of grid reliability and all these new behind the meter distributed energy resources. And so if you look at kind of some of the investments in our portfolio that we've made, like PosiGen is a great example. It's finances solar for low to moderate income households. And kind of unfortunately, a lot of the other players in the space typically kind of cherry pick the credit worthy individual, high credit households. And so a lot of people have been left out of the kind of clean energy revolution. And so PosiGen is really, their mission is solar for all. It's a company based out of New Orleans, really powerful mission statement. And kind of the unlock was, well, actually people, if you can offer a consumer a strong value prop that's lower than utility bills, and utility bills continue to increase, if you're giving clean energy generation in local communities, like people buy into that, and people will pay if there's a strong value prop. And so we're seeing that, and I think we're going to it's still in the early innings of this kind of disruption. And so the way I often like to talk about it is like, if you think about the future of what we're looking to create here, it's democratizing access. You have rooftop solar. You might have rooftop solar now paired with storage. So we just invested in a business called Lunar Energy, which is rethinking the power electronics around solar and storage. You'll have an EV. And so how does that EV interact with the grid? And can you use that EV to do really interesting things like vehicle to home or vehicle to grid type charging? How do you think about the interaction with the grid and ensuring that we don't have kind of disruption at the grid at localized levels? And so WeaveGrid helps really kind of help utilities onboard new electric vehicles onto our system. So we invested in the WeaveGrid. And then, from like an asset management perspective, like I have solar on my home here. I'm certainly not a technician that wants to be in the business of really kind of managing that asset. And so we've invested in a business called Omnidian, which is doing intelligent asset management. You basically can kind of monitor and look at the production performance of these assets, compare that to what your forecasted projection is, and any kind of anomalies you can then detect and figure out what's going on, and can we actually remediate that issue. And so that's kind of this future world that we're looking at. And I think if you then overlay that with some of the things that we're starting to get into more and more, is thinking about the kind of like the resiliency side of it. And so why do people want solar and storage in the first place? Yes, you can get the economic savings, but it's also that you're less reliant on the grid. You have basically a microgrid. So if there's a grid outage, then you can actually continue to use your electronics at home. And so we just invested in a business called Kin Insurance. And so some people might say, why are you investing in an insurance business? But as we see the effects of climate change continue to accelerate, more severe weather storms, more frequent, more severe, and that has impacts on the physical infrastructure. And so Kin is offering home insurance, and as we really think is kind of purpose built for the era of climate change. And so they're able to use better data inputs, use their data infrastructure, and then do better risk selection to offer a home insurance policy that will be more affordable versus kind of incumbent carriers out there. And not even just more affordable, like if you go into floodplains in Houston or wildfires in California, like insurers are not writing policies. And so, Kin is offering insurance policies in these kind of climate affected areas. And if you think about lunar and solar and storage and what they're offering, their battery resiliency, like that's kind of the vision of the world that we're looking to build. So I'll pause there. There's other areas that we're looking at.
That was great. Thank you so much for providing all that comprehensive insight into your investments. It was incredible. And also really appreciate you taking the time to engage in this interview. I've learned a lot, and just have one final question before we wrap up here. Given that you've had such an incredible career, where you started in consulting, then transitioned into the investment side, got your MBA, and narrowed in on a particular space. Actually, it's a two-part question. First, could you provide some advice for someone who similarly has primarily worked as a generalist and is trying to figure out how to focus that in? And then secondly, reflecting on this great career, is there any piece of advice that you would give to your 30-year-old self?
Yeah, absolutely. Both good questions. And so I think advice wise, so the kind of the the kind of decision tree that I made when I first approached business school was like, do I want to be in climate or do I want to be an investor? And I made the decision that I wanted to be in climate. And I was coming from the investing world, and I would kind of see what would happen. And so I explored both operating roles. I had an internship actually with Shell New Energy, so the big oil and gas company. Did some talked about the internship that I did with Activate. Did some other internships. So really trying to explore like what does climate look like. Was having conversations with operating companies and investors as well. So I think that's like the first thing you have to like decide for yourself. And I was willing to sacrifice. Like to me, it was not about being an investor. It was really about being in climate. So I think you need to answer that for yourself. The second thing is like you need to be versatile with the language. Like you need to speak the language of this industry. And so that just means like listening to podcasts, talking to your peers, reading articles. And so, things like Canary Media, Utility Dive, just things like that. Like just get versed in it. What's going on? What are people talking about it? And the other thing is I got it when I was in business school, was I was talking to folks about like, what would it take to crack into the sector? Like I didn't have anything on climate on my resume. And what someone kind of explained to me is that this climate revolution, this energy transition that we're on, going back to that $5 trillion that we need, like very little of that is venture capital dollars. Like most of that is deployment or infrastructure. And so what someone told me is like, hey, like you should familiarize yourself with project finance. Like that's a different world. And So anyway, I looked and explored kind of various project finance type internships, reach out to folks that have that. Like that's an important area. So encourage people to do that. And then I think the last thing on this kind of advice piece is that more kind of on the operating side is one of the stats that I think is really super interesting is that the UN has done a study about how many jobs are going to be created by the energy transition. They estimate it at being about 30 million globally. And so this is just like a ton of people that need to be trained up, that need to be mobilized. And so I think there's a lot of smart people graduating from MBA programs that that we want this talent. We want to figure out how best to kind of mobilize this workforce to really deploy the capital that's needed to decarbonize our economic system. So certainly encourage people to think about that as well. And then I think kind of thinking back 10 years or so about like what advice, going back to what I was saying at McKinsey, like, it's crazy that a 22-year-old is like having an impact at these big businesses. And so I think you come off really excited. You got a lot of young energy. You think you know everything. And like, I think the thing I would say to myself is when Satya Nadella, the CEO of Microsoft, and I'll paraphrase this, so it's not the exact quote, but basically said, "Don't be a know-it-all, be a learn-it-all." And I just love that quote because it kind of encapsulates what I do now in my current job is like, be a learn-it-all, soak it all in, learn from people that have done this before, learn from the founders that you talk to. Like, don't come in with too much hubris. And so I think like what I would tell myself is just like, be patient, like, learn from others. Like you don't have all the answers yet. And that's okay. Like starting from a place of ignorance is totally okay. Like we're all on this journey. This is a long journey to decarbonize our economy. And so yeah, have some humility in this game.
Love that. Thank you so much, Eric. Sincerely. That was incredible.
Yeah, happy to be on. Thanks for having me, and yeah, have a good rest of the day.